This video will deal with costing and budgeting. So let's talk about the introductory parts of accounting and see what accounting is about. Accounting is the main element in operating any business. The purpose of accounting is to allow businesses to keep track of their money, to keep track of their resources. Without accountancy, the business would be out of control. There is no way in which the managers or the owners of the business would be able to calculate their profitability, their stock, their assets. There's no way they could make proper decisions. So accountancy is fundamental to running any business. Accounting is all about recording, preparing and interpreting business transactions. This information is then made available to people who need it, such as managers or owners, who then make decisions to improve the performance of their business. So it's the function of accountancy to provide accurate information, up-to-date information, about the business, about all the activities of the business, to the decision makers, the people who are charged with running the business and the people who own the business and who want to see the business succeed. So it's important that there are good records of the assets, of the trading relationships that the business has, of its stock levels, of every aspect of the business. It should be recorded and should be available. There is a secondary point here that there are also stakeholders who have an interest in the business who need to know about the foundations of the business in terms of their assets, their resources, and how those assets and resources are being used, and also the success or failure of the business. For example, if we think about the government as a stakeholder, the government raises taxes from business. So it's important that the company keeps accurate accounts, true and fair accounts of its activities, so that it pays the appropriate amount of tax to the government. Accounting is the main element in operating any business. The purpose of accounting is to allow the business to keep track of their resources, of their money, as I said, but of their resources, of their stock, of their assets, to know how many machines they've got, the age profiles of the machinery, and to this end we can see accountancy being very wide and also separated out into different functions. One function being perhaps to maintain financial records, to report accurately on profitability so that the company may be taxed appropriately and that the owners may be able to calculate their rate of return on their investment. But also there's a type of accountancy which deals with looking at the assets of the business, looking at the machinery, the stock holding, the profile of the plant in general, and able to work out how to efficiently deploy the resources of the business in a way that maximizes the returns. So we have, in a sense, two types of accountancy, and these are reflected in the professional approach to accountancy. There are two professional approaches, one financial and one what we call cost and management. Accounting is all about recording, preparing and interpreting business transactions. This information is then made available to people who need it, as I said, such as managers or owners, who then make decisions to improve the performance of the business. Without accurate information, the decision makers can't make proper decisions. They can't make informed decisions. However, management accountancy is used to monitor, plan and control activities of a business. So management accountancy is more, if you like, internal to the business. It looks inside the business at the various practices of the business in a way that enables the management of the business to make more efficient decisions. It allows the business to understand how much profit they have made. So the overall financial position of the business may be reported. Those profits then become available to decision makers, and they may choose to invest in more capital for the business, or to pay out more dividends to the shareholders, to the owners of the business. But it's important that the profits are accurately recorded. It's important also that the business has sufficient resources to pay employees' wages, to pay their obligations, to pay their creditors, to pay for raw materials, and to pay for energy used within the business. In other words, they should be able to maintain the business and maintain it as a going concern, and should be able to meet their obligations. Should also, as I said earlier, be able to pay dividends to the shareholders. The shareholders invest in the business to get a rate of return. That's why the business exists, because the shareholders wanted to invest in the business because they thought it was a good idea. But also, the profits of the business may be used for business expansion. The decision makers within the business, the senior management and the owners of the business, they may see opportunities to expand the business, perhaps expand it into new markets, perhaps globalized markets, or to bring new products online. And to do that, it's necessary to have profits to finance that expansion. Now, financial and management accountancy. As I said earlier, we can start to divide up accountancy into these two areas because they perform different functions. Let's have a look at how they're divided. So we'll start with, let's just say, accounting. Accounting being the most generic heading. And then we can divide that into management accounting on the right and financial accounting on the left. Now let's take financial accounting. We can split this up into looking at cash flow statements, looking at the balance sheet, looking at the trading and profit and loss account of the business. What we say here is that the financial accounting accountants, they deal with the final accounts of the business. The final accounts are the accounts that are required by companies at the end of the accounting period. These records have to be audited properly by accountants, professional accountants, who in a sense stake their reputation on the accuracy of those accounts. So the onus is on the accountants to do a decent and open job on the accounts. In other words, to report fairly and accurately what the business has achieved in that accounting period. These are reported in the balance sheet of the business, which is a topic in itself, but essentially it covers all of the assets and the obligations of the business and shows how the business is doing at a particular date, the date at which it's drawn up. And the profit and loss account shows how the gross profit of the business is then used up to pay off the various bills and the various outgoings to give a net profit for the business. And the cash flow statement simply calculates, I should say, the ability of the business to pay its obligations on a day-to-day basis, so it doesn't run out of resources. So financial accounting, very important, because it reports openly and fairly the financial position of the business, and it reports this to the stakeholders who have an interest in knowing it, perhaps the government for taxation purposes, and the shareholders, the people who own the business. On the other side, we have management accounting, and here we can break up management accounting into cost accounting, looking at the costs of the business and looking at accurately recording the cost of the business and how to manage the business internally, but also helping the management making decisions, working out the costs of the business, the cost of products, the cost of processes, informing the management so the management can make more enlightened decisions because they have more information. So financial accounting is to deal with the financial performance of a business, and it's targeted at external users, for example, shareholders, lenders, suppliers, customers, and the government. Those would be some example of outside agencies who would have an interest in a business. And management accounting, more for internal use of a business to make the right decisions. Now, management accounting includes costing as a basis for pricing and stock valuation. It's important that the management understand the costs of producing particular products so that they can work out the prices. If they don't know what the costs are, they can't possibly work out accurate prices. Pricing is normally worked out on the basis of costs plus some sort of markup, some percentage added on to the costs to try and generate the profit. Planning, control and performance in terms of future costs and how to monitor them using budgets and standard costing methods. So standard costing methods is a subject matter of a separate video, and so also our budgeting. But it's important that the management have some idea about the costs of the business, the workings of the business from a financial point of view, so that they can work out more precisely what the budgets should be, what it costs to make particular products, the processes that are undertaken, the costs of those processes, and it will help the management to make appropriate decisions. Now, decision making includes short-term decision making, looking at the break-even, for example, and contribution analysis. Contribution analysis means that the management work out the cost of the product, the unit cost of the product, and then add some percentage to it, add a markup, and that becomes the contribution towards the fixed costs of the business. After a certain critical level of output has been achieved, the fixed costs of the business will have been paid for, and then the company will go into profits. But of course, there is a lot to be done before that happens. Effective marketing campaigns have to be put into place and paid for. All the day-to-day runnings of the business have to be paid for. So it's important that the management know exactly what's going on. Long-term decision making is more strategic management, capital budgeting and long-term finance. So we can normally consider decision making in two time periods: the short term, the day-to-day decisions, break-even, contribution analysis, and the long term, looking at strategic management. Where does the business want to be, let's say in 5 years' time or 10 years' time? And looking at the capital budgeting, what sort of equipment does the business want or need? How should it spend in terms of investment decisions? Cost accounting. Well, cost is the amount of resource, usually measured in monetary terms, sacrificed to achieve a particular objective. Now, this is a particularly economic way of looking at costs, because here, implicit in this type of definition is the idea of what we call opportunity cost, or what economists would call opportunity costs. In other words, the business has to give up something in order to get something else. So the cost of what it gets is what it's given up. So if the company has a certain amount to invest, and it can use that investment to, let's say, buy machine A, or it could buy machine B. Now let's just say let's assume it buys machine B. Well, the cost of the investment is then the machine that they didn't buy, the one that they didn't get, machine A. So had they bought machine A, of course, the cost would have been machine B, the one they didn't get as well. So we have this idea of what economists call opportunity cost. It's what we give up when we take a certain course of action. But it's certainly the case that management accountants must take costs into account. That's why they exist to some extent. They are the people who effectively monitor, control, and calculate the costs of the business to ensure its viability. So, taking cost, these objectives may be to, let's say, buy a car, to buy a house. It depends on the nature of the business. If it's a property business, it might be to buy a house, make a particular product, or to perform a certain service. Well, clearly, the more it spends on one activity, the less it has available in a different area. So it has to make decisions. The business always has to make decisions between competing demands. And it's the role of the cost accountant to provide the information to the decision makers to help them make proper decisions, good decisions. The aim of the business is to produce or to make a product or service, is to attract customers' attention, such as the public or other businesses. So the business must survive commercially. It must compete in the marketplace. It probably competes against competitors. And to do this, it must have good information. It must wage effective marketing campaigns. It must have internal efficiency. And it must be under control. And that's where the accountant fits. It's in controlling the business and in providing information which enables the management to make the decisions for it to effectively compete in the marketplace. The more people that buy the product or service, the more profit the business makes. That's assuming, of course, that the price of the product in the market has been appropriately set. And that's why the accountant is again so important in working out the true cost of making the product and to ensure that a markup is added to it to try and generate profits for the business. Then clearly the more that's sold, with each individual product making a small amount of profit, that will be aggregated over the total sales, which will generate the overall profits for the business. It is important for any business to control its costs and increase profits. Businesses exist to make a profit. That's the reason why businesses are there. So it must be controlled, and it must control its costs to ensure its profitability. Now, the classification of costs. Well, the main costs in a business include material costs, including the cost of obtaining the materials, receiving them within the organization, the cost of having the materials brought to the organization. This is known as carriage inwards. Now, carriage inwards is simply the transport cost of getting the raw materials and the components into the company. But manufacturing companies use materials to make their final output. They use raw materials in the form of components, perhaps stocks of metals or wood or plastics or some sort of material, and they then go to process this and add value to it, which will be sold on as the main product. It could be, of course, that the business is producing a service. It could be, let's say, a marketing agency that's selling the expertise of its personnel. In this case, there would be very little, if any, material costs. So it depends on the nature of the business as to the importance of material costs. There are labour costs. These are the costs incurred in the form of wages and salaries, together with related employment costs, for example, pension costs or insurance costs, the cost of calculating and paying the various workers. So there are labour costs, and it's probably fair to say that every business will have labour costs. They may not have material costs in the way we talked above. Some companies might be providing services only. So there's no, if you like, tangible outcome from those businesses. But they will have labour costs. They will have people producing those services. If it's a manufacturing business, they'll have people producing the products that are sold. And there will be expense costs and overhead costs. These could be external costs such as rent, business rates, electricity, gas, postage, telephones. So all of the services that the business need to run, these will be have to be charged as well and accounted for, and these will be assigned to the products, and it's then hoped that the markup will cover all of these because they will be apportioned. Now there are different ways of doing that. There is one way in which all the non-production costs, let's say the costs of the business rates, the business taxes, these may come in and may be assigned to the different functional areas of the business, assigned to production, distribution, assigned to the marketing department or whatever. They might be assigned on the basis of some method, some agreed method. That might be quite arbitrary, but it may be a way of ensuring that all the non-production costs are covered. It could be, in a more sophisticated manner, they use something called ABC costing, activity-based costing, ABC, in which they try to look at the activities of the business and try to assign the costs to the various activities. But there are different ways of doing it, and again, all of that is the function of the cost accountant, of the management accountant, who is there to ensure that the business runs effectively and that the decision makers have the appropriate information. They have accurate and up-to-date information about costs and about processes and about the routines of the business. So that's our general introduction to costing, budgeting, accountancy, the different types of accountancy, and some of the issues that are confronted by the accountants, and indeed the importance of accountancy in the survival and growth of business. But that's all we're going to deal with here, so let's leave it at that and say thank you for watching.